Hey everyone, welcome. This is the weekly market review for the week that just ended on June 21st. So let's take a look at how we're looking. For the most part, the markets were very quiet. It has been a quiet several weeks now in terms of volume. So the market has mostly been choppy sideways, but floating upwards. But let's take a look at it in detail and see what we want to look out for the next week. So if we just look at the S&P 500, we can see that we had that pullback over here back in April. And since then, we've gone up, we've consolidated, and we're starting to push up again right now. All of this has been on really low volume though, so we want to be cautious about it. For now, if we're just looking at the overall markets, it is up. It is definitely up. So that we'll just build on our opinion and our viewpoint just step by step. So if I just look at only this, if I clear my slate, if I forget about everything I know that happened last week or last month or this year, I'm just going to pretend I looked at nothing until today. So first thing I look at is this S&P 500 and I see, okay, it's been moving up, had this great uptrend. It broke that uptrend, had a pullback. That pullback was about 5 or 6%, 6%. And then it went up, made new high, then consolidated. And now it's at new highs again, or at least on Thursday, it was at new highs again. And we pulled back on Friday to the EMA 8. So at least so far, the picture looks great, looks very bullish, looks very strong. So I want to look at the same thing at the QQQ. QQQ is basically the same picture, very strong throughout the year. It flattened out well before the S&P 500 did, and then it pulled back, and then it started this uptrend again, and then it had to, instead of, this is consolidation, but it pulled back to the EMA 20, and then go up, make new highs again on Thursday, and then pull back to the EMA 8. So this is looking very good and strong as well. If I look at the IWM, just sideways since the beginning of the year or the end of last year. Just this huge chop sideways. So the S&P is doing well. Large cap stocks are doing well. QQQ is doing well. The riskier, smaller cap growth stocks, not as well. So that does not paint as bullish of a picture as just looking at the S&P and QQQ. But this can happen. This can happen. We can have periods of sideways trading. For example, so if I look at 2021, we went sideways all the way for the entire year until we spiked up at the very end and then came down. So what happened in 2021 in the S&P? Okay, so 2021 was basically a straight up year until the very end of the year. And then we started a bearish year. So that was a bear trend right here. So what that's telling me is that the sideways motion of the IWM by itself is not too concerning. If I see it spike up and then crash down, and the S&P can still grow through this sideways period. But if the market suddenly loses a lot of interest in the risk stocks, then that is a risk off move in the markets, and money might start leaving the stock market and then lead us downwards, just like in 2022, we had the S&P pull back for almost the entire year, or basically the entire year. Right? Before 2023, we were able to break that downtrend and move higher. So for now, we've been chopping sideways. We've been chopping sideways all year. What I want to see then is, when this finally breaks out, either to the top or to the bottom, then if it breaks up to the top, that's going to be very encouraging for the overall markets. But if it breaks through the bottom, especially now that the MA200 is even with the bottom of our channel right here, if that breaks, then we're most likely going to see a tumble downwards in the S&P 500. So now that we've seen these three indices, the picture is now more bullish, but I'm going to be cautious on the longer term because as the IWM is telling us, well, I'm just going sideways. I'm not participating in this upward move. And if I start moving downwards, then that is going to be trouble ahead. We look at the Dow Jones. Dow Jones is doing something similar to the IWM, except that it participated in this move upwards, and it's just been in this very large range up and down movement through the last few months. So it pulled back at the same time as the NASDAQ and the QQQ, and then it made a new high over here in mid-May, but since then it pulled back and just went flat. So flat that all of my shorter moving averages, all the way up to the MA90, which isn't that short, that's more of a medium term, they're all consolidated in the same region right here. So if I look over here, what happened in May 17th, okay, yes, we did make a new high right here, but we just chopped sideways. We didn't have that pullback the same way that the Dow Jones did. And even if the Dow Jones had that pullback and then a consolidation, we just have a consolidation here, but we have the consolidation in a way where I still have the rainbow separation between all my moving averages. So this is definitely a lot stronger than the Dow Jones. But if my blue chips are stagnating and my growth sectors are stagnating, so my IWM, my small caps, and my blue chips are both stagnating, how much further can my S&P and my QQQ go? It's going to be kind of limited. If what it's telling me now then is that we're isolated into probably a limited number of sectors. So, and since the QQQ is way up, then those sectors are probably tech and consumer discretionary related. So that's what we can gather just from looking at the indices. And that's a pretty good picture already, but we do want to look even further detail just to see what we can dig up. So I'm going to look at volatility of the S&P 500. Volatility is low. It's about the average for 2024 at the current moment. So that's telling me nothing immediate, nothing that I need to be immediately careful of because we're just at normal levels. If I start breaking above this 15 and a half, then I'm going to be concerned about a drop. If I pull back down to these lower levels, that's not going to signal too much. I'm already at all-time highs. It's not like the VIX can go that much lower. And if I did, it hasn't been lower than this level for since 2018. So I can't realistically expect that it's going to move lower. The market is different than it was in 2018. COVID changed a lot of things. It's interesting, though, that we are at levels immediately before COVID. Why? Because after COVID, a lot of retail money came into the markets. We had Robinhood, and we had Robinhood introduce zero fee, zero commission trades. And then we had the other discount brokerages come in and match that, or at least very low commission trades. And so that sucked in a lot of money from retail traders. And so now we have a lot more retail trader participation than in the past. And so we can't necessarily expect that volatility will ever get back down to these levels right here. Therefore, the new normal in volatility is probably in this 12 to 14 range. So I'm not really going to expect that volatility to move downwards. If I get a hint that these markets might start to roll over, then I can start buying some calls as hedges in my portfolios in case volatility spikes way up. Let's take a look at our put to call ratio. This hasn't been telling us too much recently, although right now looks like as of Friday, we're at 0.72. So that is it's supposed to be the number of puts over the number of calls. So that means there's a lot of call buying in this market. We're feeling very enthusiastic, but we're probably overstretched. we moved this. Before we were always looking at 0.7, and in that case, we'd be at the edge. But recently, we can see that we never really hit 0.7 that many times in the last couple of years. And so we adjusted it to 0.8. So this level right here is telling me that there has to be a little bit of a snapback. So a temporary consolidation or a mild pullback would bring this back into line. So if I look at my S&P, this is what we got on Friday was that mild pullback to the EMA 8. If we have a pullback to the EMA 8, sometimes that's it. Sometimes that resolves it and I'm good. But the fact that our CPC is still at 0.72 after that pullback to the EMA 8, that leads me to believe that there's potential for us to even pull back to the EMA 20, which isn't that big of a deal. That would still be considered on a medium term. I would just call that consolidation. It would be, so, okay, we broke out of this box and now we're just trading in this box. That's what it would look like. So because you notice that EMA 20 is at the bottom of that box. It's at the top edge of this box. So it's not a big deal if we pull back down to the EMA 20. That would just be choppy sideways movement. If we were bounce off the EMA 8 and go higher, then this box is invalid. Right? We're not looking at choppy movement. We're looking at upward movement. So next week, we should get a confirmation of which one that is. So the CPC is telling us maybe we have a pullback to the EMA 20, but even if that happens, that doesn't change at least the bullish picture that we're seeing so far. Now we start looking at momentum and two gauges of momentum, so number of stocks above and below their moving averages, and then also the number of stocks making new highs and new lows. So if I start that process with an equal weighted index, this is starting to look a lot like the Dow Jones, DIA. We had a peak here, and then consolidate. The difference, though, in the Dow Jones is that this peak is higher than this peak. And the RSP, this peak, the first peak was higher than this peak. So it's in even weaker position than the Dow Jones. It has been consolidating. All the moving averages up to the MA90 are still in this area and we're chopping across it. But the fact that this peak is higher than this one, that is not great news. And once we leave this consolidation period, then we will get a directional move. And the question is which direction. And just based on that, and based slight edge towards the bottom. When we look even deeper into momentum levels, that might change. Maybe the edge will go to the top, or it'll be a greater edge to the bottom. We'll just have to see. We can continue on with everything that we're looking at. So QQEW is better shape than that Dow Jones and the RSP. We have equal peaks. And we have a series of higher lows. So that's making a flat top, and that makes the breakout more likely to the upside. How much more likely? Maybe about 10% more likely, so about a 60-40. So we're not looking at a huge probability of it moving upwards, but it is the higher probability. So if QQQ goes up, then that will help the S&P 500 because all the large cap tech stocks, all the FANG stocks, they're all in the QQQ and the S&P 500. And if those are the ones that are leading, then it'll drag the S&P 500 up as well. So let's look at, I should have looked at this earlier, but let's look at the dollar and then the bonds. The dollar looks like it's on its way up. That was putting pressure, that will be putting pressure on the stock market unless people are going into the dollar with a specific use of something other than buying stocks. So if I go into dollars specifically to buy oil, if I go into dollars specifically to buy US Treasuries, if I go in specifically to buy gold, then that won't have much of an effect on the stock market. But if we're just going into dollars just to be as a safer haven versus other currencies, then that's going to have an impact on the markets, and that's going to be downward pressure market on the markets. TLT, you can see that bonds, yeah, they in the short term they moved up, but really basically we broke above this flat line and chopped sideways. I'm not going to go too far into it because for the last couple of weeks we've been talking about bonds and the probability that they're going to come back into this channel, at least to this 88, 89 region or the MA50 region, probably below the MA50 region at this point. You can see that MA50 is getting very close to this downward channel that we have right here. So most likely below that as well. And because of these probabilities are skewed, of the probabilities in July 31st of the rate cut is too high. This 10% should be in September, not in July. And so I won't go into that. If you need a review of that, then you can look at almost any of the videos in the past 2 weeks. So TLT chopping sideways, but we are expecting that to come back down inside this downward channel. And then let's look at, we looked at dollar, bonds. Okay, so we'll go back to momentum. So I go over here and I look at my momentum. So up until this point, what are we seeing? We're seeing bullishness in the major indices. We're seeing disparity in the Dow Jones and in the IWM that makes us less bullish. We took a look at our equal weighted, and that is making us less bullish as well, although the QQEW is looking reasonably good. So we want to watch very carefully this week if this breaks out. If this breaks out, then our view is going to shift more bullish. But for now, we're slightly bearish of neutral. So if I now look at my momentum, the number of stocks in the overall markets that are above their 50-day moving average, only 39%. And that is with markets hitting all-time highs. That is very, very negative news. That is not encouraging at all, especially given last month that we were at 55.65, and now we're only at 39%. And then same thing with this 200, 51% of stocks above their 20-day, so or 200-day. So that implies that on an equal weighted basis, they should be the price should be very near the MA200, but we're at all-time highs. And a month ago, we were at 62%. Now we're at 51%. So that is also very discouraging. So what it's telling us is that the foundation is weak. And for this market hitting those new highs, the foundation is really weak. And if this number starts to go below 50%, it's going to be even weaker. So this is a number that we're going to be watching this week. The number of stocks in the overall markets that are above $2 that are also above their 200. And if that breaks the below 50%, we're going to get even more bearish on this market. If we look at it in terms of our major indices, and what we see is that S&P is at 52 and 68. This is more healthy looking. 52 is a little, it is above 50. That's good news. The bad news is that we're at all-time highs and only 52% of stocks are. So this is bearish, not as bearish as what we just looked at in terms of the overall markets, but this is definitely bearish, very not comforting at all. And then we look at the Russell 2000, only 48%, 62. So we saw that Russell 2000 is chopping sideways. This is more in line. There's not a huge disparity here because we are chopping. Well, let's make sure. Are we chopping across the MA50? Yes, we are. Okay. So this is more of what we would expect the S&P to look like, but obviously S&P is not. It's making new highs. So there is that disparity, and then that disparity is most likely going to resolve itself to the downside rather than a sudden rise in the number of stocks above their 50-day moving average. It's possible, but what would have to happen in order for that to occur is that we would need to get market breadth. So suddenly all these numbers that we see in all these different sectors that are so far below the 50-day moving average, they would have to come up to 50 and above. So that we're talking about utilities, materials, industrials, financials, energy, consumer staples. That's a lot of sectors that we need to rise up in order to make this picture a lot more comfortable. It's more likely that, because really, realistically, all that has to happen is for tech to come down. And if tech comes down, comms will come down with it, and consumer discretionary will come down with it. So basically, if we get that pullback in the QQQ, then this is like a house of cards. It'll drag these other ones, maybe not healthcare, but it'll probably drag real estate with it because it's interest rate sensitive, and the tech draining money out of tech would imply that they're a worse yield than a index interest rate like the US Treasury. And if they're a worse yield, then what makes the real estate a better yield? It's not going to be. So money will drain out of that real estate as well. And so it's much easier to get the market to come down in line with the current momentum levels than it is to get the momentum level up and in line with where the market is. So that is more bearish, more of a bearish viewpoint. Dow Jones, what's really interesting is that we've got sort of the opposite problem in the Dow Jones. We've got a healthy number of stocks in their 50-day moving average, above their moving average and 200. But when we look at the Dow Jones, we're basically just barely above that MA50. We're a healthy amount above the MA200, but not a healthy amount above the MA50. So what's that disparity? So what that's telling me is that there's money not focused on the blue chips. That money has gone into speculation. Specifically, in the current market environment, that speculation is in AI and chip stocks. So does that mean that the Dow Jones can move higher? No, money is moving out of the Dow Jones and into speculative sectors. And what we're seeing in terms of momentum is that movement is not sustainable, because yes, that sector is growing. That sector is growing, but nothing else is growing with it. And that's what we call a bubble. It's not going to be able to sustain itself unless everything else starts to get pulled up with it. Can AI by itself pull everything upwards? On a long-term basis, maybe. We can argue that AI makes everyone more productive and makes it, industrials more efficient, more productive, which will consume more materials, which will consume more energy. There is an argument that yes, we become more efficient at everything, and that efficiency allows us economic growth, and then all of this can move upwards. Is that going to happen in a month or 2 months or 3 months or 6 months? Probably not. Probably not even 1 year or 2 years, but on a 5 or 10 year basis, sure. So if I'm looking at a more immediate picture, remember I'm doing weekly market review. I'm looking at the next week, maybe the next month. So that type of potential is not going to save me in the next week or in the next month. So all it is doing right now is stretching it even more, this disparity between the AI and the rest of the sectors. So for now, that is going to be counted a short-term bearish. And then if we look at the NASDAQ is looking more like the Dow. Do you see? So this momentum-wise, the NASDAQ is looking the same as the Dow, but now the NASDAQ picture actually does match its momentum. So that's really interesting. So we looked at our QQQ and we said, okay, QQQ is looking bullish. And then we looked at the QQEW. We said, hey, it's not looking bad. It's actually looking like it could break out. That's looking pretty good. And then we look at the momentum levels and we say, hey, this picture matches. The picture actually matches this all-time high. And I have a reasonable number of stocks above all of their moving averages. So this picture actually matches. Now that gives us a little bit of a conundrum because we're okay, well, it matches for the QQQ. It does not match for the S&P, does not match for the Dow Jones. The S&P and Dow Jones, if I look at this inconsistent picture, I should be bearish. But if I look at the picture for the QQQ, I should be bullish, which is interesting. QQQ bullish, if it actually breaks the upside, it can bring up the S&P 500, and it can bring up, well, less likely, but it might have an upward influence in the Dow Jones. So suddenly, the fact that the NASDAQ is in alignment is bullish. That's erasing a lot of that bearish sentiment that I've been building up in this picture so far. And what it says is, I'm getting conflicting pictures here. So should I be bullish? Should I be bearish? Should I be... When this happens, it becomes a lot harder to predict or get a good and clear picture, which means what? It means higher risk. If I can't get a clear picture, then I have higher risk. If I'm driving down the road with 20/20 vision, yes, I have risk driving down the road, but it's not nearly as high as if I have blurry vision or I forgot my glasses and I can't see that well. It doesn't mean I can't drive down the road, depending on how bad my eyesight is, but it's not as safe for me as if I had my glasses on and I could see perfectly. So what we're saying is, oh, this suddenly, it just blurred our picture. It looked very much like we're developing a very clear picture, and suddenly we got this information and now it's blurry. And now I have higher risk. Well, I have higher risk, then I should be more neutral. I should be more conservative. Also, when over the overall balance of everything that we just said, okay, we have all these things that are bearish, we have this thing that is bullish, and we net all of that out, I should be neutral. And so there's a couple ways now that we're looking at these markets that are telling me, hey, you should be neutral. We were developing this bearish picture, but you should be neutral. Or if the only thing I look at is the NASDAQ, you should be bullish. But I'm looking at everything, and so you should be neutral. So far, this picture is developing into a neutral perspective. Let's take a look at our advances and declines, and then we'll look specifically at our sectors, and then we'll have looked at everything. So let's go to advance and declines. Let's do it just for the S&P 500, and we'll do it on a quarter and year to date, which is be half year. So close is greater than close 6 months ago, 349. That's a healthy number. Remember, if I take away this criteria, I should have roughly 500. I have 489. So there's currently some rebalancing going on in the S&P 500, so we don't have quite 500, but I have 489. So the halfway point would be 245, 46. So anything between just say 225, 230 up to 260-ish, 265, that would be just flat, neutral, 50-50. So, but 350 something is well above that number. So that's bullish. Bullish on a 6-month basis. Flat, neutral on a 3-month basis. Bearish on a 1-month basis. Okay, flat on a 2-week basis. and flat to slightly bullish on a 1 week basis. So that's interesting because if I look at the S&P 500, if I go 6 month basis, clearly the S&P is much higher than it was at the beginning of the year. So that picture matched. How about on a 3 month basis? 3 month basis, we were flat. So March 23rd. Let me do a ruler, March 23rd. Okay, over here. So we are clearly higher right now, almost 6% higher. So my momentum on a 3 month basis is more advanced declines on a 3 month basis does not match the actual market performance. And then on is 3 month bearish? 3 month was bearish. No, 1 month was bearish. So 1 month is bearish. So a month ago would be May 23rd. Okay. We're up almost 5%, but we were bearish on that 1 month momentum. So this is looking like, so obviously if I go 1 week and 2 weeks, this is still going to be upward momentum. And those were neutral, and on the 1 week basis, it was slightly bullish. So a lot of these timeframes don't match. We're getting bearish or neutral momentum, but the market keeps going higher, which is not super sustainable. Yeah. Okay, so far, everything that we looked at is the picture is blurry. It's not crystal clear, and that is telling us just be neutral. Yeah. Is there anything, or is there any sector that I can be non-neutral about? Well, everything that we saw, QQQ seemed pretty clear that that's bullish. So most likely, the most clear picture we're going to get is off of the tech and consumer discretionary. So let's take a look at that. So on a average basis over the last year, SMH, XLK, XLC, tech. Okay. If I look on a 6-month average basis, SMH, XLK, QQQ, communications, once again, tech. If I look on just a pure 6-month basis, SMH, QQQ, XLK, XLC, home builders has been up there in all the ones that we've looked at so far as well. I look at 3 months, SMH, XLK, QQQ, utilities, that's interesting. Communications, let's see where home builders is. Home builders at the very bottom, that's interesting. I look at a 1 month basis, SMH, XLK, QQQ, XLC, and then home builders near the bottom. And then if I look at a 2 week basis, XLK, SMH, XLY, okay, and then home builders are in the middle. 1 week basis, XLY, XLF, XLC, XLK went to the middle. That's interesting. In the last week, what we're saying is that we got a little bit more market breadth in the last week. Because it was tech. Suddenly, just in the last week, we're seeing a little bit more breadth. That is more bullish. So that is something that we want to really, and then home builders way at the bottom, we really want to keep an eye on this week is how is tech going to do? Because it was the golden child through all of these, but just in the last week, it's flipped. And we have other sectors rising. So if I look at my XLK or my QQQ or my SMH, I need to watch this very carefully and say, okay, well, we definitely hit a new high up here, a very clear, strong upward movement. Are we going to pull back to that EMA 20, or is this it? Does it bounce from here? If it breaks the EMA 20, then do we go to the MA 50? This is going to be critical to watch over the next week. SMH, same thing. Ended at the EMA 8. Will it fall to the EMA 20? Will it fall to the MA 50? Or will it bounce and recover? So everything is hinging on the AI stuff. I guess that's not too surprising. But we've very clearly developed this picture that is blurry. And so we will be neutral. And then we need to pay particular attention to XLK. So that means that, yes, QQQ looked great and it has a lot of potential and has the most potential out of everything in order to move upwards. However, what we're saying is in the last week, some risk and some danger popped up. And so we want to sit and watch that very carefully. If QQQ or if the tech sector fails, the picture that we've developed so far was that we're on thin legs propping up all these new highs, and those legs are tech and semiconductors or AI stuff. And if we lose those legs, then the markets start dropping. If those legs strengthen and move higher, does that mean everything else strengthens? Not necessarily. We would want to be in the tech sector to go long. But what we want to see is, do these other sectors that popped up in the last week, and if I look at it, the 1 week change, okay, respectable, 1% and above. So do these continue to go up as well? In which case, I'm starting to get market breadth and the overall picture starts to get stronger and healthier. So this is going to be a pretty critical week. We could, of course, get no new information and everything just chops sideways, but I don't think that'll happen. I think we'll get a pretty clear picture, and we'll be able to be non-neutral sometime after next week. Hopefully, neutral is a difficult place to be in. You got to be really, really good at picking and timing everything. And it's hard to be really, really good at picking and timing everything when you only trade at the beginning, at the open. If you could trade intraday, then that's a different story. We can time things a lot better. But if you're only looking at market close data and then setting up your trades for tomorrow open, then it becomes a lot more difficult. So hopefully we get non-neutral soon, and then our life and our job becomes a lot easier, and it becomes a lot easier for us to make money. So for now, we're in neutral and wait and see mode. And another thing that's going to be very important to see is this volume coming back into the markets. So remember, look what happened on Friday. Friday we had average. Thursday we had average, but remember we were discounting this because of the quadruple witching that always boosts up volume. And then, so what we'll want to see is, do we keep hitting the average or go above it in the following week? And then with that volume, does the QQQ move higher or lower? Or more specifically, does XLK, does SMH, do those two move higher or lower? And those are going to be critical components. So for now, we're going to stay neutral. There's probably not going to be a lot of trades over the next week as we watch this. And we really need to develop a clearer picture before we can start putting more capital than we already have to work. Yeah. So I'm happy with that picture. I think that was very thorough. We have a very good idea of what's happening currently in the market and what to expect over next week. Let's just see if there's anything on the economic calendar in the next week. See if we have any catalysts. So we've got some housing stuff. Oh, we have a consumer confidence. I thought we just had consumer confidence. Okay, so if this is consumer confidence, then that'll be important to watch on Monday. Monday? Tuesday. And then we've got more real estate stuff. So next week could be interesting for real estate. GDP, that'll definitely be important on Wednesday. So we do have some catalysts, core PCE and personal income, that'll be important. So we do have potential for volume to come back in and to get directional. So hopefully after this week, we'll be non-neutral. We'll have a clear direction. Any questions? Anything you want me to go over?
Okay, thanks, brother.
All right. Thanks, guys. I will see you tomorrow morning at the open if you guys are available. Otherwise, I'll see you sometime during the week. Have a wonderful rest of your weekend and a great week coming up. I'll see you guys later.
Bye.
Bye.